Welcome to Real Estate IQ Wisdom for Smart Moves. We will explore the insider secrets tailored exclusively for Silicon Valley home buyers, sellers, and investors, arming you to conquer the unique real estate landscape. So, without further ado, let's dive into this exciting conversation. Today, we welcome Sarah Klisch, the private wealth advisor of Ameriprise Financial. She aims to empower individuals with financial tools and knowledge to make informed decisions and achieve financial freedom. Nearly half of American households aged 55 to 64 face a retirement savings crisis. Compounding this, only 17% of Americans reported having high school financial education, highlighting a critical gap in knowledge. In 2022, investment fraud and scams in the U.S. soared, with losses nearing $8.8 billion, a 30% increase from the previous year, including over $3.8 billion from investment scams. These trends emphasize the urgent need for improved financial literacy and awareness. The following content is only for informational purposes. Please consult a licensed consultant for your specific situation, or if you need any specific legal or tax advice.
Sarah, welcome to the show.
Thank you very much, Sharad. I'm very happy to be here.
Can you share a brief background about yourself and your expertise as a financial advisor?
Sure. So I went to Berkeley and got a business degree. But I think what really defines the difference that I bring to the table is that I had a lot of life experience before I came to this career.
Right.
So I have worked in small businesses. I have worked in the nonprofit sector. I've worked in media. So I've done a lot of different things, human resources and marketing, and event planning. And so 24 years ago this month, when I started this career,
Oh my God.
I came to it with a very different perspective. And in large part, it was a strong desire to take all the skills that I had from those other things and apply them to something that could really help people move forward in making financial decisions. Because we're all presented with financial decisions every day in some way, shape, or form. And so being able to be a part of some of those larger decisions and help people with the education that they need is really what I found appealing about this career and what still makes it fun after 24 years.
What financial challenges does a common person face?
Well, when they're first starting out, it's honestly that decision-making of invest in a single-family home or not. And so with that process, what I usually try to help people with is basic cash flow management initially, right? Because the challenge in buying property of any sort, frankly, is even though you can write off mortgage interest, et cetera, right, you still have to pay the bill.
Right.
And so having a clear understanding about how you handle your finances, where money's going, so that you can ensure that you have the resources available is the first step. Looking at how, if they can't do it right now, right? What do we need to do financially to put them in that position? Is it, borrowing money from a down payment from family, if that's an option, right? Is it working a couple of more years, and if they're in tech, utilizing restricted stock units,
right,
or employee stock purchase plan, right? So figuring out what the various different elements are that they can tap into in order to make that investment, if that's something that is of interest to them, is one of the financial challenges that I see. Second phase in most people's lives is starting a family and then planning for college.
Mm-hmm.
And unfortunately, in my personal opinion, college has become a very expensive proposition.
Yes, it is.
And so even to send a child to a UC Berkeley, where I very happily went, is a large bill today.
Right.
And if you have an infant today and you project based upon the inflation factor, it's an astronomical amount of money. I really hope it won't be that way, right? However, be that as it may, we need to have an understanding about what is the parent's goal in terms of the financial obligations, right? Is it paying for a portion of it or all of it? Is it paying for all of it to go to a certain level of institution, but not to pay for it if you're going to an Ivy League school, right? So having clarity first about what that goal is, and then figuring out what the financial obligations are. How much money do you need to set aside now in order to make that happen is something that I feel is valuable to empower people. And then as part of that, I oftentimes encourage them, family and friends are going to enjoy tremendously giving things to your child. Those things won't last very long, but that education will last them a lifetime.
Right.
So if you, in your heart, as a parent, can communicate to those people, okay, give them something small, but contribute to their college education fund, that's a great way to get kind of everybody invested, not meaning the pun, but it is true, but also make an impact for that child that will last them a lifetime. The third thing that I see people struggle sometimes with is this concept of retirement, right? And so helping them first and foremost to have a better understanding about what that looks like. What does that mean for them? Because people define retirement differently. Sometimes it's, I want to get to a certain age and I just want to stop. Sometimes it's, I don't really ever envision myself not working anymore. I just want the financial flexibility to not have to do so, right? So first it's helping them define what that looks like. Then that helps to inform what kind of monetary goal we have out in the future. And how do we then incrementally break that down and monitor those goals over time, right? So it's not just a one process situation. It's being able to check back in on a periodic basis to make sure that you're still on track. And if you're not on track, what's the thing we have to do? How do we have to address that, right? So those three things are the things that I see people kind of grapple with the most, right? Purchasing their first home, sending a child to college, figuring out retirement are three big financial elements that I can help people focus on and move the needle forward and help them get to where they want to be.
So what advice will you give to the teens or young adults who are new to investing?
Yes. So first and foremost, people have to understand that everybody has a different comfort level of risk. And being able to understand how you yourself view money and how you assign risk is really important, because you can look and say, oh, so-and-so invested in this particular stock, right? And they did very, very well. But it might be that their risk profile is significantly different from yours. And if you had done that same investment, if it had been very volatile along the way to get to that end goal, you might not have felt very good, right? So first is to have a clear understanding about how you approach money and how you approach risk. Secondly is make sure you have a savings account first. You got to have a safety net. If you're investing everything and something goes awry, which happens in the market from time to time, right? Then where are you going to go for the basics should you need them? So you need to have a safety net, right? And then educate yourself a little bit, right? It's not difficult to learn about investing, but it takes some time and it takes some interest in doing so. And, you could work with a financial advisor to begin that process. But honestly, there's a lot of really good basic information available so that if you do then decide to work with a financial advisor, you come with your own sort of basic education tools, right? So you can have a more collaborative relationship, because investing is something that is very emotionally based for a lot of people, right? We tend to be very emotionally tied to money as human beings. And so when things go well, we want more of it. And when things don't go so well, we wanted to say that we're going to protect it all, right? And so having a better foundation on your own about how you view money, how you feel about risk, and some basic understanding of the market will help you to help yourself, basically, right? To not be emotional when things aren't going the way you want them to go. And the other piece of that I would say is, in addition to savings, you have to understand what is the goal you're working towards and what's the time frame. Because if it's a short-term goal, let's say you are planning to do a remodel on a home and you'd rather save the money than use an equity line of credit. Okay, fine. Well, maybe that's a 2 or 3 year time horizon. That's a very different risk profile for everybody than a goal that's 10, 15, 20 years out, right? So investing based upon the time frame for the use of the money will also help to inform the level of risk that you would be comfortable taking based upon your own risk profile.
How do you help resolve some of these challenges?
Well, it first begins by asking a lot of questions, doing a lot of listening, right? I think that the fallacy that some people have about my profession is that we give you all the answers. And that's not really the case, right? We have a lot of tools, information, potentially products, etc., right, that could possibly be good in a particular situation. But it's not our decision to make. Our role, if we're doing it properly, is to be able to provide people with enough information,
right,
without information overload, right, so that they can then process it and go, well, okay, based upon my circumstances, I'm thinking X, Y, or Z. What do you think, Sarah? Okay, well, let's talk about that. You've now given me some information based upon how you're digesting that information. So let's talk about that and come to something that makes sense. So I think, honestly, no matter what the general context of the interaction is, right, it's always a matter of asking questions, listening, asking more questions to kind of to get to a point where we can then make some decisions, right? Through that process, my role is to be a fiduciary, right? As a certified financial planner, I am not supposed to be looking out for my own best interest. And Ameriprise, my firm, is the same way. Whether we're CFPs or not, we're all held to that fiduciary standard, right? So looking at the general context of the types of things that we can provide advice on, such as investment products, insurance products, debt management, right? And coming to a consensus with a client about what makes the most sense for them based upon their circumstances is really where I believe I can help people move forward. Because sometimes it's just the thing you don't know that much about that keeps you from taking action.
Right.
Right? And the reality is that there's a point in time, there's the information that we have available at that point in time, and then there's a choice to either act or not to act. Both are conscious.
Right.
It's the fact that oftentimes humans act unconsciously. They're not really thinking in the forefront of their minds about here's choice Y or Z, or here's information A or B. They process without really knowing how they got to that point. And I think that when you talk about working with a financial advisor, it's bringing that out to a conscious level. And with that, I think the benefit of that process is that people then understand why they did something.
Right.
And when you understand why, you're more likely to stay committed to it if it's still the right path, or to say the why at that time made sense, the why now does not make sense. So now, is there something different I should be doing, right? And that's really the role that I play with my clients over the long term, right? Is that we work together on a collaborative relationship. We figure out a particular path. If that path then changes for any number of different reasons, we go, well, okay, it's changed. So how do we now apply the new situation, the new information, so that you can move forward and make a choice? And that's how I feel like I help empower people, right? Is to giving them those opportunities to have those conscious decision-making processes that help them move forward.
What key strategies can help people manage their finances smartly?
So first and foremost, one needs to be conscious about the choices you're making, and understand what your financial goals. Why is that important? Well, I have people who come to me to get advice and they say, I want to grow my portfolio. Okay, well, that's a common goal, right? That's not unusual. But what is the purpose of that particular pile of money, right? To grow it just to grow it for growth's sake is okay, but it doesn't give enough context, right? So what I share with people is that to be effective in your financial life, it is helpful to have a goal or more than one goal. Because with that goal, then you can determine milestones, benchmarks, am I on track or not on track, and be able to make accommodations and changes as needed. So first is being conscious about it, having goals. Once that's in place, then it's being mindful, right? If you are in a circumstance where you don't have to worry from paycheck to paycheck about how you're paying your bills, which hopefully we all get to at some point in our lives, right? We oftentimes become immune, for lack of a better term, to where the money's going. And so we spend because we can, and then we recognize sometimes that we don't have the resources that we wanted to for a particular goal. Well, we probably have those resources. It's just a matter of being aware of where is the money going now, and is that the choice you want to make? One thing I tell people all the time, financial choices are not good, bad, right, or wrong. They just are. However, could you potentially have made a more informed choice that would have moved you closer to your intermediate or long-term goal?
Right.
And so if you understand how you're spending your money, and then you decide that you want to make a different choice about that in order to change that process to move that money to something else, then you're going to be more successful, right? The other thing that I would share with people is don't be too concerned about what other people are doing.
That's so true.
Because the bottom line is there's a lot of external signals that we attach to financial success. Wearing nice clothes, driving nice cars, living in big houses, right? But I can tell you as a financial advisor, some of those mirrors are interesting when you pull back behind and you look at how are people actually functioning financially, right? So my caution to people is don't necessarily compare yourself with somebody else. Think about what's important to you and how you want to operate, and let them make their own choices, right? It's not bad to talk to people about what they're doing. That's fine. But it's I think, a self-preservation to be sure that you're taking care of your own stuff and don't worry about too much about how you think somebody else is doing. And if you do that, and you're mindful about how you're utilizing your funds, and you set a goal, you will get there. You will.
A typical problem homeowners have when wanting to buy a new home is whether to sell first or buy first. Either way is risky. When ready to look for a new home, TradeMyHome.com, powered by Your Home Sold Guaranteed Realty, offers an upfront guaranteed cash offer on your current home. Are you moving in the next 3 to 6 months? Text PAIR to 408-740-7400 for a free and no obligation professional equity appraisal report. For more information, visit TradeMyHome.com or call 408-740-7400. Remember, at TradeMyHome.com, your home is sold guaranteed or we'll buy it.
What is your advice on effective debt management?
This is an excellent question, because debt can be a very powerful thing They can also be very detrimental, right? So my basic counsel in effective debt management is do not go into debt for things that do not last. So what do I mean by that? So revolving credit card debt can be very useful for leverage, right? Utilizing the credit card company's money until you pay the bill off, right? Or very rarely when there's a larger expense that you don't have the ability to pay off, but you have a plan to get it paid off in a very short period of time, right? Because revolving debt is painful when it accumulates over time and it becomes the thing like a black hole that sucks all of your financial resources to try to serve it, right? On the other hand, effective debt management is utilizing debt to invest in property that's going to appreciate over time because you are going to, over the longer run, have the ability to have an asset that's going to be worth more than you borrowed, right? We're at an interesting time right now with interest rates because for the last, 15 years or so, we've been able to take out mortgages for very low amounts of money. So I've been doing a little cleaning of paperwork. And I found the first paperwork for my home that I live in now that I bought in 1996. I didn't remember this. I had a first and a second mortgage. My first mortgage was 8 3/4. The second was 9 1/4.
We're almost there.
Yeah, we're almost there, right? But we forget, right? So the challenge, of course, I understand today, that level of interest expense makes buying the property that a year and a half ago seemed affordable, not as affordable. However, it is, if you can do the stretch, right, it is something that first and foremost, you're in. Secondarily, somebody said to me once, you date the property, not the rate, something like that. So
date the property and marry you marry
the property and date the rate.
Yeah.
That's it. Yeah. So, at some point, it is likely interest rates are going to go down. Probably not in the next year or so. So work with what you have, right? Buy to the limit that you can comfortably or with a small stretch, right? Invest in, and then look to potentially refinancing when the rates go down, right? So my general counsel for people on effective debt management is don't use revolving credit except to your advantage, not to the credit card companies, right? Use debt to buy things that will appreciate over time and reevaluate that debt when things get better and refinance it, right? Rather than just paying that over time if you don't have to.
What is your advice for retirement planning?
Sharad, this is my favorite question. So retirement planning when you're younger, let's do this in phases. Okay. So let's say you're 25 or 26, you're out of college, you've worked a couple of years, and this amorphous thing of retirement is, 45, 50 years down the line, right? Very hard conceptually. Humans don't think like that, right? We just don't. And yet, what I describe to young people is the power of compounding, right? If you think about the beginning portion of savings, it's this little acorn, right? And then over time you add to it and it becomes a walnut, and then it gets bigger and it gets bigger and it gets bigger. And finally it becomes a snowball. And that snowball rolls downhill and it gets bigger and bigger and bigger and bigger. And that's because of the power of compound interest. Right? And so the younger you begin by setting aside funds that you, in your mind, set a wall. It's behind the wall. I don't get to use it. It's not available for me now. It's for my future me, right? The better off you'll be. The less, honestly, you'll have to save over your lifetime because of that compounding effect. And the other element that I share with young people is if you can do it, pay the taxes now. So our two primary ways of saving for retirement are putting aside money into a 401k, if that's available to you, or if you're a self-employed individual, setting up your own retirement plan, right? And most of us do that on a pre-tax basis because we get a tax benefit today and we'd like to lower our taxable income, right? But what that's doing is pushing the tax bill down the road.
Right.
And so if you can manage it from a cash flow perspective, and you can save that money into a Roth 401k or just invest in a taxable account and do it in a tax efficient manner, right? The power of that money further down the line is so much greater from a spending perspective because it's not going to be subject to taxation. Right? So with young people, I just tell them anything, do something, put 3% in your plan, right? And every time you get a salary increase, put it into the plan, right? Just make that a habit because that money will be there for you when you're farther down the line. Right. When you're in your 40s, that's the time to start thinking about what it's going to look like 25 or 30 years ahead of time. Because most people in their 40s can see retirement. It's a little less amorphous, right? It has a little more shape, a little bit more form. They can articulate what it might look like, what it might feel like. So that's a very good time to start checking in if you haven't been paying attention before, right? If I want to maintain my current lifestyle or what it's going to grow to with inflation over time, and with the current amount I'm saving and what I've already got saved, am I on track? Yes or no? Sometimes people don't want to know the answer to that question, but ignorance does not help you make changes in course, right? So finding out where you stand in your 40s and early 50s, really key, right? Let's say that you say to yourself, I want to be in a position of not having to work by the time I'm 65, right? It's like, put a stake in the ground, let's figure out, can I do it, right? That is something that once you understand, are you on track or not? 5 years out, so when you're 60, if you say 65 is it and you're on track, 5 years out is when you need to start figuring out your retirement distribution strategy. Here's why. Accumulating, it's not easy, right? You have to put the money aside. You have to pay some attention to the investments. Sometimes, frankly, the less people pay attention to the investments, the better, because they usually shoot themselves in the foot, right? But by the time you get to 60, you usually do not have any idea how to take the money you have saved and turn it into a paycheck. And there's so many different factors that go into that. There's planning for your Medicare Part B premium, which is directly driven by your income. There's planning for tax brackets, which today are pretty generous and pretty low, but may not be that way when you go to retire. So understanding how is that money that maybe got saved mostly pre-tax actually going to be spent? How much is it going to be worth to you based upon the tax brackets, right? And then there's should I take money out of my pre-tax accounts early? Should I wait until I have to, those required minimum distribution things that my current clients who have to take them hate? I don't need the money, Sarah. Doesn't matter that you don't need the money. The IRS wants their taxes, right? So understanding what are the right pools of money to pool from. Should I start Social Security at my full retirement age, or should I delay it, right? These are all elements of your retirement distribution strategy that if you have a clear understanding about how that's going to work 5 years before you get there, now you can line everything up. You line all your investment accounts in such a way that they support that plan. And then you have a little bit easier time making that transition, because it is the most difficult transition I see people make. It's like jumping out of a plane without a parachute, because suddenly there's no paycheck anymore.
How does the current economic climate influence the investment strategies?
First and foremost, we're in a very dynamic economic situation at the moment. And there's a lot of uncertainty as individuals, a lot of fear in some cases with regard to investing. I get people asking me frequently, why should I put money in the market now if maybe a recession is coming? Won't it just go down, right? So the way that I help people through these types of processes and through the thinking is we have to think about, again, the money in time frames. So money that is going to be needed in the near term, say in the next 0 to 3 years, is not money you want in the market, right? Market's too volatile, right? So you need that to be in interest-bearing accounts, which currently we actually have. What a lovely thing. That has been a nice change. Not great for mortgages, great for savings, right? So interest-bearing type investments, looking at potentially laddering of CDs, money market funds, things that aren't going to create volatility but are going to earn you some better interest, right? Then for monies that are maybe 4 to 7 years out, we might pull back. If you're normally a risk taker for long-term money, then what we would do is bring you back maybe 2 ticks, so to speak. So that money that's the 4 to 7 year time frame, again, you could weather a cycle or two because you've got the cash, right? So you could take a little more risk, but not as much risk as you would take with money that you don't need for 8 to 15 years, because that's got at least a couple of cycles, right? So what I try to help people understand is that being out of the market is not a good strategy. But what you want to do is be confident about what the time frames for each of those buckets are going to be, and that they're allocated appropriately for your risk tolerance, so that when things do get choppy, which they do, you can look and go, okay, that's right. We have a plan. Got short-term money, medium-term money, long-term money. As long as my risk profile has not significantly changed, I should just take a deep breath and recognize that the plan in place is going to get us to where we want to be. Because we cannot control the economy. We cannot control the market. All we can control is how much we're saving and how we react when things go poorly.
Right. Can you share a success story which involved your financial advice?
I will use a first name that is not hers. We'll call her Bertha.
Okay.
So Bertha became my client 15 years ago. Single mother, 2 young girls, living paycheck to paycheck, having overdraft protection put onto her Star One credit card. Not good. Not good. And I said to her, Bertha, this is not a good strategy, right? We've got to get this debt paid off. You have to stop buying stuff at Target for your girls just because they say they want it. This is not going to be financially successful for you. And she kept the same process for about 4 years. Well, a couple of circumstances changed. First, she got a certificate that allowed her to do a different job within her company. So she was able to make more money.
I see.
With more money, she was then able to start to pay down the debt. We did a very clear program. She had 3 credit cards, actually. So we started with, here's the credit card with the highest interest rate. You pay the minimums on everything else, you pay that one down. Take that money, you put it on the next highest one. And this is a very good strategy. It works very well as long as you stick with it, right? So she did that, and she saw that it was making a difference, right? So she got all the credit card debt gone, and then she went, I'm never doing that again. And she started putting money into savings with the goal of paying cash for a car, which she did. In the meantime, daughters are growing up, becoming adults, getting their own jobs, starting to help a little bit with household finances, etc. And they move out. Mom continues to be successful, right, at her job, making more money, being mindful of what she's spending, so she's got more disposable income. Now, Bertha did have the benefit of working for a company that had a pension. So this did help, okay? But she came to me 3 years ago and said, Sarah, I think I'm ready mentally to retire. And I need to know that financially I can do it. She was 61 at the time. So we took a look and we did all the numbers. And she had turned everything around. And I said, if you want to do this, you can do this financially. She said, okay, now I have one other thing. I want to buy a house. I said, okay, where do you want to buy this house? And she said, I know I can't afford to do it here because I have to keep my payment the same as what I'm paying in rent right now because you just showed me this. I said, yep, you're right. She says, okay. So she started looking. She decided she was going to move to outside of Denver, Colorado. She found a house and she was able to put a down payment on it. Her payment is the same as what her rent was with, payment, mortgage, property taxes, insurance, same as her rent. She was able to give notice. She retired a year and a half ago. She moved to Colorado. She is so happy. I just talked to her this last week. She's having a wonderful time. She's exploring her community. She's taking care of her health, which she hadn't been focused on. And I said to Bertha, what you're just telling me right now about what you're doing with your health is the same way you felt empowered when you figured out you had control over your own financial life. You did all the hard work. I just gave you the tools, but you had to embrace it and do it, and you did. And you're going to do the same thing with your health. So I'm thrilled for her because it truly is kind of a rags to riches story, and she did it all on her own. It was great.
Thank you, Sarah, so much for your time today. Keep up the good work, and let's stay in touch.
Thank you, Sharad.
Thank you for listening to the podcast and acknowledging the wisdom of smart moves in real estate in Silicon Valley. Please share this episode with a friend, subscribe, and leave us a review on Apple Podcasts or wherever you listen to podcasts at Real Estate IQ. Thank you to our sponsor, TradeMyHome.com, for their client commitment and for making this podcast possible. If you're considering buying or selling a home, visit TradeMyHome.com. Until next time, remember to stay ahead in the real estate game.